tradable trends, then you want to look at perhaps a shorter term time frame, and ideally you would like those types of time frames to coincide with the clues that you're getting from your predicted difference lines down here, and also from your neural index. You want to have kind of everything be on the same page, and you don't necessarily always get that, but you'd like to have it be that way if you possibly can. Now, when we look at the various candles to kind of analyze this in a little bit more detail about where to enter or exit a market, let's start with the candle that we had, let's see, November 23rd. Okay, we're going to go over here to November 23rd. We're going to shorten, I guess we can maybe even cut our time frame down a little bit further to make it a little bit clearer. I don't know if that would help. Let's do this. Let's go to our real short time frame and look at only 2 weeks. And that way we can make our drawing a little bit clearer here. 2 weeks, a 2-week time frame to get an idea of more likely what is going to be happening in the market using the predicted differences, or the predicted highs and the predicted lows. And again, we're going to look at first this candle, November 23rd. Now, November 23rd candle, got that on the the candle where it indicates that we we're definitely moving down. And you don't have the indicators down here when we're going, if you go straight down, look at these indicators down here. You don't have those indicators at that point until after the day's data is collected at the end of the day. And when you have those in, then you can start to make some, some analysis for what to expect for the following day. So looking at that November 23rd candle, you can see that the predicted differences were pointing down. You can see that the neural index was at 0, so there was kind of a bearish indication. The typical price would be lower in 2 days than it was at that day. And then the day after Thanksgiving, we have a skip day in here. Now I know this is for U.S. traders. Maybe the majority of them are still recovering from Turkey and whatever. But for those, if you're an international trader, it may not have been that much of a day and not that big of a day, but a lot of difference for the U.S. trader. So the day after Thanksgiving, if you were back there trading, you could see that the possibility existed that knowing that the indicators below were on the bearish side, you could try to do a strategy where you fade the predicted high to take a position, a short position, assuming that that would be the high end of the range for the day. That's just a preference. It doesn't necessarily guarantee it will be that way, but the preference, if you have a preference to trade based on the indicators, you're going to go that way. So the predicted high on that day was 134.20. We're going to fade that predicted high and do a limit order 20 points below the predicted high. And 20 points comes from kind of a, there could be any number of different points that you could use depending upon your style and the amount of risk you can take and so forth. But when you look at the average daily range, it has been running around 2 cents, and so you like to take maybe 10% of the average daily range and use that as your fade amount for entering the market. And we're going to use it also for exiting market, which I'll explain in a bit. But in this particular case, the predicted high was at 134.20. We are going to fade that by 20 points, and we are going to, on a limit order, sell at 134 even. Now, again, it might not be exactly where, any other person might have a different thing. You want to make sure that it is small enough, that 20 points is small enough so that if the market pops through that predicted high, kind of gets out of sight, that you can then get out of your position quickly without a big loss. So you might not want to have more than, let's say, a 40-point loss altogether if you are wrong. So one of the reasons for sticking fairly closely to that predicted high for entering the market is that you don't want to have that risk factor increase so that it could take you out of a chunk of your money if you happen to be wrong. In this case, okay, 134, you're going to have a limit sell order, and if you have several strategies for getting out, you can say that the predicted low that we had down here, that pink line, that particular day was at 132.79. So we're going to add 20 points onto 132.79, and that means that we would close out the position, the short position at 132.39, and that would put you out somewhere in the vicinity right not precisely in here, but somewhere right in here, because you're going to fade the low, assuming that, again, we started in right in here, entering the position on the short position, we are out of it on this particular position right here, and we're done for the day. That means we don't have that overnight exposure, because that's when some of the surprises come about that can be the big losses. That's one strategy where you can fade the high, fade the low, get out during the day. The other possibility that you could do is you could let that market kind of run down toward the close. Again, the close in a market like the euro, a lot of your international markets, your global markets, especially in the currencies. And again, I should also point out here that I'm using the Euro FX futures. I know there are a lot of people that trade cash Forex, so each cash Forex price is going to be a little different, but I use the Euro FX futures as a frame of reference just because that's kind of a constant. I can't tell you what each of the cash firms are going to be offering for their their bid and ask spreads, how many pips they're going to have, and those are the types of things that everybody has to kind of make up for themselves. In any case, short, a quick day, 100 basis points, not too bad. And then you have a situation where you don't have a setup. You have a couple of days in here where you can't really say that you would have had the same type of situation. You do have one of the criteria met. You do have an open that comes in the middle of the day, the middle of the predicted range. You have an open, and you have an open. I guess I should point this one to the high side. You have the open in the middle of the range, what you want, and then you kind of wait, see which way the market goes, and then go on the basis of that by fading either the predicted high or the predicted low. Now, when you look ahead, let's focus now on the current time, and we're going to look at this candle right here. This is a candle for November 29th. The candle was set up here. When you look at after this data was collected, the end of day data for this day, November 29th, the indication was the Euro index was at 1. The predicted differences were pointed up. If you remember, we were starting to take a little turn in the predicted exponential moving average that we saw on the previous screen. So you can see that the indicators were showing that, if anything, you would like to be on the long side on the following day. That means you'd want to buy the predicted low if you could possibly get it within the range of what you're trying to do. So on November the 30th, which was yesterday, you would be looking at the predicted low as kind of your key point. Now, it may not necessarily be the thing that you'll actually trade, because you don't know what that day is going to bring until you actually have it here. But we have a situation here where we had the predicted high, 134.17 on that day, the predicted low, 132.64. That's the pink line, the gold line. So the range was set. The open came at 133.32, right in the middle of the range, which is what you would like to see. Then as the market drops toward the low, kind of, sinks down here towards the low, and at this point of the predicted low, you said that the predicted low was 132.64. You add 20 points